The richest investors in the world are quietly selling massive chunks of tech stocks, while the media tells you to stay calm. Jeff Bezos, Warren Buffett, Bill Gates, Jensen Huang, Michael Dell, these aren't just names. They're the architects of the modern tech revolution. And in 2025, they've sold over $16 billion in stock at the exact moment the market hit all-time highs. So the question isn't whether something's happening. The question is, what do they know that you don't? Let's start with the numbers, because they're staggering and they demand attention. Jeff Bezos led the charge. In a series of planned transactions, he offloaded $5.7 billion worth of Amazon shares, totaling 25 million shares. Just like that, gone. Safra Catz, the CEO of Oracle, followed closely behind, selling $2.5 billion of Oracle stock. Michael Dell wasn't far behind either, dumping $2.2 billion of his own company's shares. And then there's Jensen Huang, the public face of the AI revolution at NVIDIA, who quietly liquidated $1 billion worth of stock. On their own, each of these sales might seem ordinary. Billionaires sell stock all the time. They rebalance portfolios, fund personal projects, or diversify risk. Nothing unusual, at least on the surface. But then we get to Warren Buffett. In 2024 alone, the Oracle of Omaha sold an eye-watering $143 billion worth of stocks. And he didn't stop there. In 2025, Buffett continued selling, unloading another $24 billion. That's $167 billion in total. This wasn't trimming around the edges. This was one of the largest sustained sell-offs by a single investor in modern history. And Bill Gates? His foundation recently slashed its Microsoft holdings by nearly 65%. That translates to $8.67 billion exiting the very company he helped build from the ground up. Now, at this point, you might be thinking, so what? Rich people sell stock all the time. They diversify. They plan ahead. This is normal. And you'd be partially right. But here's what makes this wave of selling different. The timing. Most of these transactions were executed under Rule 10b5-1 trading plans, prearranged, legally structured sales designed to avoid accusations of insider trading. These weren't emotional reactions to market fear or breaking news. They were deliberate, calculated decisions mapped out months in advance. And when did they happen? Right in the middle of the AI-fueled tech boom, when valuations soared, headlines screamed optimism, and tech stocks reached historic highs. These insiders weren't fleeing a burning building. They were calmly walking out while the party was still raging, locking in profits at peak enthusiasm. History shows that insiders tend to sell for many reasons, but they buy for only one. They believe prices will go higher. When selling becomes this widespread, this coordinated, and this well-timed, it sends a quiet signal. Not panic, not fear, but preparation. And the question now isn't if something changes, it's when the music stops. So why now? Why are the smartest investors in the world choosing this exact moment to take chips off the table? The answer is hiding in plain sight: valuations. As of December 2025, the S&P 500's price-to-earnings ratio, specifically the PE10 ratio that smooths out short-term volatility, hit 39.8. That puts it in the 99th percentile of its entire historical range. The market is more expensive now than it's been 99% of the time in modern history. The market is currently trading 79% above its long-term trend line, and the standard PE ratio, 90% higher than the modern era average. In September 2025, the S&P's PE ratio touched 30. The last time we saw a number like that was during the dot-com bubble between 1998 and 2002. We all know how that ended. It took 7 years for stocks to regain those. Before the 1929 crash, the PE ratio hit 20. Before the 1987 meltdown, it reached 21. We're at 30. Now, does that mean a crash is imminent? Not necessarily. Markets stayed overvalued during the financial crisis and COVID too, but those spikes happened because earnings collapsed, not because stock prices went parabolic. This time, earnings are still strong, but prices have simply run too far, too fast. Warren Buffett saw this coming. In his own words, he noted that the current capital gains tax rate sits at 21%, compared to 35% before 2017. By selling now, he saved $14 billion on $101 billion in gains. That's not just smart investing. That's financial chess played at the highest level. But it's not just about taxes. It's about what happens when markets get this expensive. Here's the critical part most people miss. Billionaires aren't just selling, they're reallocating. Warren Buffett offers the clearest example. In the first and second quarters of 2025, Berkshire Hathaway quietly moved $779 million into Lennar, one of America's largest home builders. On the surface, that might seem counterintuitive in a high-rate environment. But Buffett isn't chasing headlines, he's chasing valuation. While the S&P 500 trades at historically stretched, near nosebleed levels, the rest of the market tells a very different story. Mid-cap stocks trade at roughly 16.3 times forward earnings. Small caps? About 15.8 times. That's nearly half the valuation of mega-cap technology stocks dominating today's indexes. In other words, the crowd is paying premium prices for growth, while Buffett is quietly buying cash flows at a discount. At the same time, Buffett dramatically increased his exposure to safety. In 2024, Berkshire added $166 billion in Treasury bills, locking in a risk-free yield of around 4.3%. No drama, no volatility, no hype, just predictable, tax-efficient income while the rest of the market competes for AI-driven returns. That's not fear, it's discipline. The Bill and Melinda Gates Foundation tells a different, but equally revealing story. The foundation has announced plans to increase annual grants to $9 billion by 2026 and fully spend down its endowment by 2045. That requires liquidity. Selling Microsoft shares at all-time highs is not a loss of faith, it's financial planning. And here's the key detail most headlines ignore. The foundation still holds over 9 million Microsoft shares. This isn't an exit. It's portfolio optimization executed when valuations are stretched and liquidity is abundant. Hedge fund leaders are following the same playbook. Stanley Druckenmiller completely exited high-momentum names like Nvidia and Palantir. Ken Griffin cut his Amazon position by 39%, selling roughly 2.1 million shares. But they didn't leave the market. They rotated. Capital is flowing into names like Adobe, Broadcom, AMD, and other companies offering stronger risk-reward profiles at more reasonable prices. This is the pattern. The smart money isn't panicking. They're not calling the end of the market. They're rebalancing at the top, quietly positioning themselves for whatever comes next. Let's zoom out and look at the bigger picture, because while history never repeats exactly, it has a habit of rhyming. The most obvious comparison is the dot-com bubble. From 1998 to 2002, markets traded at valuations that look eerily similar to today. Optimism was everywhere. Innovation was real, and prices detached from reality. When the cycle finally broke, the Nasdaq collapsed by 78%, wiping out trillions in value. It took 15 years for the index to fully recover. But here's the important nuance. That crash was driven largely by companies with no earnings, no durable business models, and little more than speculation. Pets.com wasn't Apple. Webvan wasn't Microsoft. Today's market leaders are very different. Big tech companies generate massive cash flows, sit on fortress-like balance sheets, and dominate global industries. These are real businesses with real profits. The risk today isn't quality, it's price. Think of it like buying a great house. The construction is solid. The neighborhood is desirable. Demand is strong. But if you pay 3 times what the house is actually worth, it doesn't matter how good the property is. You've still made a poor investment. Not because the house fails, but because the valuation leaves no margin for error. And markets can stay overvalued for longer than most people expect. They did in the late 1990s. They did again during parts of the 2010s. Valuation doesn't tell us what happens next week or next month. It tells us where we are, not where we're going. It's a signpost, not a roadmap. What history does tell us is this. When valuations reach extreme levels, future returns tend to shrink. Not necessarily turn negative. Not collapse overnight. Just disappoint. And yet, the fundamentals still look strong. The S&P 500 returned 26% in 2023, 25% in 2024, and is already up 14% year-to-date in 2025. Corporate earnings continue to grow, with projections of 12% growth in 2025 and 14% in 2026. So we're in a rare environment. Strong fundamentals pushing already expensive prices even higher. That kind of momentum can absolutely continue, until it doesn't. And when expectations are stretched this far, the smallest crack, slower growth, tighter liquidity, or changing sentiment can matter far more than anyone expects. Not because the system is broken, but because the price assumes perfection. So what does all this mean for you? First, understand what this is not. This is not a signal to panic sell everything and hide in cash. The billionaires aren't doing that, and neither should you. But it is a signal to get smart about risk. Here's the framework. 1. Valuation awareness matters. When markets are expensive, future returns compress. That doesn't mean sell everything, but it does mean adjust expectations. If you're expecting another 25% year, you might be disappointed. 2. Diversification is your friend. If megacap tech is overvalued, look elsewhere. Mid-caps and small caps trade at much better valuations. International markets offer compelling opportunities. Real assets like commodities, infrastructure, and real estate can provide ballast. 3. Quality over hype. Buffett's strategy is instructive. He's buying companies with strong fundamentals trading below market multiples. He's avoiding the AI frenzy and focusing on businesses that make money today, not hypothetical profits 5 years from now. 4. Tax efficiency matters. If you're sitting on massive gains in a taxable account, now might be a smart time to harvest some profits, especially if you believe tax rates could rise in the future. Rebalance intelligently. 5. Don't try to time the top. Even the billionaires aren't calling a crash. They're taking calculated profits at advantageous moments. You can do the same without trying to predict the exact peak. The key insight here is this. The billionaires are playing a different game than most retail investors. They have tax optimization strategies, access to private markets, diversified portfolios spanning asset classes most people never touch, and most importantly, they're not emotional. They're not selling because they're scared. They're selling because it's rational. Here's the paradox at the heart of this story. The market is simultaneously rational and irrational. Rational because earnings are strong, AI is transformative, and economic growth continues. Irrational because the prices we're paying for that growth assume perfection for years to come. The billionaires are navigating this paradox by taking profits during strength, not waiting for weakness. Think about it. If you knew you could sell Amazon at all-time highs, lock in billions in gains, pay a historically low tax rate, and redeploy that capital into undervalued opportunities, wouldn't you? That's not market timing. That's portfolio management. The lesson for everyday investors isn't to copy every move billionaires make. It's to adopt their mindset. Think long-term, but act tactically. Stay diversified. Understand valuations. Don't let FOMO drive decisions. Because here's the uncomfortable truth. When everyone is euphoric, when every dip gets bought instantly, when PE ratios hit levels only seen at historical peaks, that's not the time to go all in. That's the time to be cautiously optimistic. The S&P 500 could absolutely go higher from here. It could hit new records in 2026. But it could also consolidate, correct, or enter a prolonged period of sideways movement as valuations normalize. Nobody knows for sure, not even Warren Buffett. But what we do know is this. The richest investors in the world are reducing risk, taking profits, and preparing for a range of outcomes. They're not betting the farm on continued euphoria. And maybe, just maybe, that's the smartest signal of all. So here's my question for you. Are billionaires sending a warning signal, or is this just routine portfolio management at scale? Do you think retail investors should follow the smart money and take some profits? Or is this the exact time to stay the course and keep buying? Drop your thoughts in the comments. I want to hear your perspective. Are you rebalancing your portfolio right now, or are you staying fully invested? And if you found this breakdown valuable, hit that like button and subscribe, because we're going deep on market analysis, investor psychology, and the moves that matter. Thanks for watching. I'll see you in the next one.